Thanks for joining today, Hugo. I've heard this rumor that you can get a mortgage which is basically fixed rate, but you can still take advantage of rate drops as they happen. So I'll be real, sounds like a scam. So I'm hoping you can shed a bit of light here on what this really is and how does it work.
Yeah, so you know what? This particular solution just came out of the very interesting rate environment and mortgage environment we've seen in the last couple of years. I feel like we've had to be very creative with solutions because we don't want to recommend solutions where you're going to be locked into a relatively high rate as we're seeing rates finally start to come down. So essentially, that's kind of where this came out of. So we've kind of consulted with various lenders, and through some of the features that are built into the mortgage, we're able to identify a solution where you can lock into a short term. It could really be anything, but the way we're looking at it is lock into a short-term fixed rate. Right now, the 3-year fixed rate is where the banks are really, really aggressive and the pricing is very attractive. It's also a relatively short time frame, so you're not locking in too long. But the disadvantage is basically that when you're locking in today's environments into a fixed rate, you're stuck with that rate for 3 years. So as an example, we're recording this at the end of July, but we saw in the last 30 days, roughly 2 rate drops consisting of 0.5% drop. So any client who's recently taken out a mortgage, or any client who's taken a mortgage in the last 30 plus days, it's probably sitting 0.5% higher than anyone today. And with September, October Bank of Canada announcements coming out, it's likely another 0.5% of rate decreases and so on, right? So it's almost like a difficult conversation. Should I go with this fixed rate? Should I go with something different? So what we came up with was, and we're calling this a cascade strategy. There's a very specific lender, which I won't name on here, that will do this. So what they'll do is they'll give you a regular 3-year fixed rate, but they allow very generous prepayment privileges. And this is really important. So through these prepayment privileges, we're actually able to do 40%, which consists of 20% prepayments, which are done in 12 months and 1 day. So the idea is you do your first prepayment within your first year, and then literally the next day, you do another 20%. So realistically, 40%. By doing that 40% and reducing your mortgage by 40%, we then take the amount that you prepaid, so that 40%, and we convert that to a new mortgage at whatever the rates are in the future. So if you're getting $1 million mortgage at 5% today, as an easy example, and we're able to prepay that down to $600,000 and give you a $400,000 mortgage at, let's call it 4% next year, which is very realistic, you're going to save 1% on that whole amount that you just did, which in this example is about $4,000. And then you can do the same process the year afterwards. You have all these multiple segments. So as rates go down, and I wouldn't say immediately, but as rates go down, you have the option of strategically paying and converting that into a lower rate without any penalties, without an appraisal, legal fees. You don't even need to apply for this. This is just an administrative thing done at the branch. There's obviously a little bit of logistics behind the scenes, which we'd have to kind of get into a deeper dive, but that's kind of the deal. In this way, you're able to enjoy, the benefit of a fixed rate while still benefiting if rates are aggressively discounted in the next year or two and so on. So that's kind of the idea. And it's been really, really, really popular. Because I know a lot of people are on the fence, are like, man, I really want to go fixed, but like, I don't want to be like a month in and rates go down another 0.5% or whatever it is. So yeah, it's been really popular. By also taking a fixed rate, it allows your borrowing power to be higher. So we're finding that given how expensive real estate is, getting into a variable rate mortgage, which is still really attractive, and I think probably more attractive than it's been in years right now, qualifying criteria is a little harder. So for those clients that need a little bit more, getting into a fixed rate will allow you to get access to more funds. And I think right now is, it's a turning point. I think it's a really attractive time to be looking at buying real estate while the market is generally still relatively sleepy, I would say, and you would know better than me, but we're seeing that it's kind of quieter than it should be. As rates further discounts come in, I think we'll see a lot more movement. A lot of those people on the sidelines jump in, and now values will start to creep up. So I think it's important to have a strategy to deal with rates coming down while still qualifying today.
Yeah, I mean, like, there's 2 things to go through. Let's talk about the first one in terms of like market timing. Like, we at Volition are not advocates of timing in the market, timing of the market. We very much believe time in the market. But our crystal ball lets us, there's a bit of crystal ball work here, and I can tell you as rates start to come down, buyers are going to start to come back in, and we already see this in our little microcosm of Volition clients, where interest in buying and actually a whole bunch of buyers have jumped in the last, I don't know, month and a half. Like it's become very busy for us all of a sudden, because they're a little bit more sophisticated as buyers go. They know prices are going to start coming up, and they're trying to get ahead of that, right? So, if you're waiting for the actual rate cuts to happen, you may get a 0.5% on the rate, but you may be paying another 100, 200,000 on the asset, offsetting any sort of rate advantage that you're getting, right? So that's one, a very good point. Two, it's a question actually. So that you've got the initial mortgage, we'll call that mortgage one. That gets paid down maximum to, let's say, 60% of the value it was previously. The other 40% is turned into
40%, yeah.
Yeah.
It
So
gets paid down to
you're paying
60%. So I
down that.
understand. Got it.
Yeah,
I misunderstood. It gets paid down to 60%, which is a 40%. Got it. Sorry.
So that 40% that gets turned into a second mortgage. Is that any second mortgage, or is it like a particular type of second
So
mortgage?
that's a good question. Under the umbrella, what happens is we approve you for a credit limit. So let's call it $1 million because it's an easy number. In the $1 million credit limit you can have multiple segments. So if you were to apply a prepayment, that second mortgage segment would be whatever term makes sense for you at that moment. So if you feel that, hey, let's just go variable. Whatever it is that makes sense at that moment, that's what you should take. So there isn't a restriction as to what you can take. It just depends on where rates are at and what you're comfortable with.
Okay, that's pretty cool then. So just kind of doing the mental math here, I'm probably I'm still having still a blended rate between my original mortgage and whatever this new mortgage is, but I'm able to make a pretty big dent because I can take 40% of that value and reduce it down to whatever is basically current, right?
Well, here's what's important, Ming, is I think there might be some people listening to this saying, like, this sounds interesting, but I don't have 400 grand. Where am I going to find 400 grand? So you don't need to have 400 grand or 200 grand. You just need some amount of prepayments. Let's call it 10 grand, which could be done through a line of credit that you already have or some cash you already have. You just need some amount. As you pay down the mortgage, you've opened up some room, which is now available to you to reborrow, and you can kind of keep recycling until eventually you've done your max prepayment. This specific feature is unique to this lender, and it's something that you can do. Because that's the number one question I have is the client called me on, they're like, I just bought my first house. I literally spent all my money on the down payment. I don't have 200 grand or whatever the number was for her. But there is a way to do it as long as you have something to start prepaying it.
Yeah, that makes total sense. So good to touch on that. And the other thing is like that 400 grand is basically it's returned when you get that second mortgage back. So there may be a portion of time. So it doesn't necessarily need to be your 400 grand. Maybe
it doesn't matter.
If your parents have a HELOC, right? You can use that, pay it down, mortgage it back out, pay back that HELOC, right? Like there's
a lot of different ways to do it
for a little while.
There's a lot of ways to do it. In fact, this particular lender on their approvals, they generally will say, hey, I mean, you're approved for whatever, $1 million. Here's your rate. By the way, we're giving you unsecured lending, not linked to the real estate, for like 10 to like 75,000, I believe, is their highest. So there's ways to access funds to be able to do this. And again, this doesn't work for everyone, but it's a way to blend the mortgages. And when you say blend, what you can technically do is walk into your bank with your existing mortgage and just tell them to reset your term back to the original, and they will reduce your rate through like a blended, it's called the blend and extend program.
Oh.
So if you're sitting at, let's say 6%, you're locked in because you were freaking out last year, you're sitting at 5-6%, whatever the number is, you could call your current lender and have them reset it back to the original term. So if you did a 3-year fixed and now you're like a year in, you could go back to the original 3-year fixed, and they're going to take a percentage of what the current rates are and what you had based on the ratio of your term, and they're going to reset it down a little bit. So you could do that. Okay. The problem with that is they're never going to give you the best rate. They're just going to make up, maybe use a posted rate or something that doesn't make sense. And now they got you for another 3 years. So this is a way better solution now because you're getting a pure second mortgage segment with, you know, a proper rate.
Yeah. No, I like that. And do the terms of the second mortgage line up exactly with the first, or is it like
That's a good
completely
question.
opposite?
So that's probably where there's a bit of like, I wouldn't say gray area where it can get a little bit tough because you could start with a 3-year rate, but maybe the best term available that moment is another 3-year rate. So now you've got like 2 years and a 3-year. That's kind of where it gets can be a little bit administratively confusing. But if you're happy with the terms you're getting and the rate, it beats breaking the mortgage and paying a penalty or not having access to this feature. So it's pros and cons, right? I think that's probably the biggest one.
Yeah.
But again, like you could maybe take a 2-year rate and match the terms
Yeah.
if you want, as long as the rate's lower. So I think
Yeah.
that's the main point.
Yeah, I mean, like, it's absolutely worth the trouble, the administrative trouble in my mind, because
It's a
not like
once a year
that
thing
much
that
work
takes
for you.
I mean, people are
Yeah.
on like their phone, their social media feed probably for hours a day. This will probably take you max 30 to 45 minutes at a branch
Yeah.
visit. You know, there's no significant effort involved. So yeah, it's definitely worth it.
Yeah, well, that sounds awesome. I'm glad we got to connect today on this. So it's
Just a
not
little
a
insight. Look,
scam. It's very creative. I
it's
like that.
we've investigated, you know, again, not every lender does this. I think there's only one lender that'll do it exactly where it actually has real value. Because the other thing that is important to note is when you prepay, your mortgage payment remains the same with most lenders. Not every lender will float your payment down. So the strategy is attractive, but if you can't float your payment down and you're stuck with your original payment and a new mortgage, now you've just increased your mortgage payments. So this allows you to actually float the payment down and then add the segments. So not only is the rate going down, but your payments are also going down too. So it's both an interest savings opportunity and a cash flow savings opportunity as well.
Yeah, yeah,
So
it's absolutely win-win. I love stuff
it's a
like this.
solution for the times that we're in now, you know, as an option.
Yeah. If people want to find out more about this, how do they get a hold of you?
Just emails, usually the best. You know, we'll probably put a link on this video here, you know.
Yep.
And we'd be happy
And you
to
can,
have a conversation and see what we could do.
awesome. And you can always slide into our DMs. We'll make sure you get connected to Hugo, and we're always happy to help.
Yeah, definitely.
Awesome. Thanks a ton for your time today, Hugo. Always bring a lot of value.
I appreciate it, man. I appreciate sharing sharing any of this stuff. And, you know, hope you have a great summer. Hope everyone has a great summer. I know we're kind of getting to the second half of that. And yeah, look forward to connecting as well.
Cool. Thanks very much.
Thanks, Bing. Take care.